I'm Brendan Yurik, the CEO of Electric Royalties. We are a royalty company focused exclusively on those clean energy metals, really required to move the world into a clean energy future. We've got a portfolio of 22 royalties, one of which is still subject to closing. We've got 2 cash flowing royalties now, a third one imminently about to enter production. We've had about $420 million raised by operators going into our assets since acquisition. Another $100 million in planned financings announced over the last couple months. So, it looks like it should be a very good year for us.
Brendan, thank you very much for the introduction. Good to see you again. We spoke about 2 months ago, and we had a bit of a dive into your portfolio. We looked at some of the assets and things. I would like to just kind of take a step back and have a slightly more macro discussion, please, this time. Really on how lithium companies are valued, where they kind of are best had, when's the best time to hold them in a cycle, that kind of thing. And I get it. From your smile, I can tell you're going to tell me the best time to have a lithium company is all the time. But I guess
Not necessarily. I think a royalty company is always good to hold. I think lithium equities.
Sorry. I meant to say royalty company. A royalty company is the best time to hold a royalty company is all the time.
Yeah. So you're right. You're right on that one. But I think lithium equities have gotten a little away from themselves. It's funny. The market's always like that. We target 9 clean energy metals. We think the opportunity really across the board is the same that you've seen in lithium this last kind of 18 months, 2 years. The market is funny like that. It's kind of like a bandwagon. And, right now people just understand and have just been learning about lithium. And, it's obviously one of the key ingredients. It's kind of the first one that's taken off. But we see that opportunity really across the board for these metals. And we think that's going to happen in time. I think lithium equities are a little bit crazy right now. Obviously there's been a ton of groups that have come out of the woodwork. So there's a lot of, kind of questionable maybe assets out there. And there's a lot of lithium supply, I think, long term. But right now it's great to be in the lithium space. We've got our flagship lithium royalty, Oche. That's about to enter production. It's going to be part of the largest lithium mining operation in Canada this year. And where lithium prices are right now, that's going to be very good, obviously for what that is paying out to us. But I think, generally in the market, I think the lithium equities have kind of gotten a little bit crazy. Maybe some of the other metals that we target, those companies are a little bit beaten up. So, we expect that to normalize as we move forward.
Yeah. Sorry for my brain focus on lithium. I was meaning to say royalties all the way through that. But at PDAC a couple of months ago, sorry, it's not even a couple of months ago. It was just 1 month ago. It feels like so long since I was there. The mood was beaten up. Among those junior companies, it was looking quite beaten up. And just before this interview, I 2 days ago, you put out an update on 7 of your royalty, on a portion of your portfolio. And this is when you mentioned the amount of capital that's been raised and the amount of investment that's been made into that project. Into that portfolio. Around $500 million has gone into your portfolio. But what I was struck by as I went through the list of the companies was that some of them are really quite micro cap. It was a slight disconnect between the size of some of the companies and the amount of money that's gone into the projects. I mean, perhaps care to comment on that? Yeah,
I think generally our operators have done a pretty good job of being able to raise capital and to move those assets forward. It's kind of funny. We had the same calls from investors when we went public 2.5 years ago. One of the best ones was about a company called Sayona Mining. They operate our Oche Lithium project. I think right now their market capitalization is about $2 billion. When we bought into that asset, their market cap was about $5 million. And so, obviously, you've seen an incredible growth in size. And they're a lithium company. Lithium has been the first metal to really kind of take off. But like I said, I think we expect that to happen, for the rest of the metals and the rest of these companies, over this next 5-10 years. And it's just going to happen a little bit, I think, staged. Lithium has been the focus. Everybody has jumped into that. And so you've seen valuations really take off. But, at the end of the day, we have metal shortages really across the board for 9 different metals that we're targeting. They're all going to be essential for the world to move forward to clean energy. And so, people, I just don't think recognize that yet. And that's really, I still think a great opportunity. It's, means there's opportunities for us to continue adding royalties, because royalties are great when equity valuations aren't, so I think it's just that it means there's lots of opportunity out there. I can understand how people, look at the operating size of these companies, but, these groups have the best in class assets for these metals, primarily in Europe, North America, and Australia. So, you can't recreate those. They took millions of years to form, and they're really the very few. So,
it was one of the companies I looked at actually was I think it was in your list of 7 assets that you provided an update on. The 4th one, it was a project called Graphite Bull. I think it used to be called Yilga.
Yeah. It used to be the former Yalga project. Yeah, Buxton Resources. Yeah.
Yalga. And the company's called Buxton Resources, and I just looked at the market cap, and I thought, $30 million. And I thought, there's another micro cap. And I looked, and I expanded the share price to full screen, and it's gone on a real tear in the last 2 months. I mean, it must have been a micro cap 2 months ago, and it's had a really good jump from $6 million up to $30 million Aussie.
Yeah, and honestly, I mean that project's starting to really kind of take off. We liked that project, what they initially had when we bought in, and that's been over a couple of years ago. And they were really just quietly working around on the metallurgy for a number of years. And so, there's a lot of long lead items that aren't very sexy. Metallurgy's, I think, the most important aspect of anything clean energy metals focused, given the purities and whatnot that you need to make batteries. So. But yeah, in the last couple of months, I think people started to really pay attention. Now they're looking at the exploration potential on that project. It was already pretty high grade. They look like the exploration's gone quite well. And the metallurgy, since you have that kind of comfort that, you've had some success there, you can actually do something with the graphite at the end of the day. That's a project that can move forward very quickly. I think the graphite space is primed for, something similar to what has happened in lithium. It's a little bit more complicated. I don't think it's got as many eyes yet. That's a perfect example, of a project that, we liked 2 years ago, and it's finally starting to kind of catch, investor interest and gain some momentum.
What do you feel when I was walking around PDAC, when I look at the kind of the macro financial environment, the macroeconomic environment, I really feel that this is a kind of a time of uncertainty and kind of financial risk, and that gets my head thinking down the kind of the gold route. It makes me think of precious metals, and if I could think of kind of the kind of more industrial metals, I kind of go conservative. I kind of start pulling my horns in and go to something like copper, which is. It's a bellwether for the economy, and that's held up surprisingly well, possibly kind of tightness on supply and stocks being pulled down. But I don't immediately think of the minor metals. I don't think of the battery space. I see all of that as kind of a long-term mega trend, but perhaps having a dip at the moment. Are you seeing the dip? Do you feel? Yes, we've spoken a little bit about lithium, but are you getting lots of calls about? Do you see lots of opportunity in that space? And is that a function of a lack of capital? So there's a lack of competition for your dollars, or is there kind of is the focus actually still on these minor metals?
Yeah, I think definitely we are exposed to copper and nickel, zinc. I mean, those are already very big markets. Lithium as well. We've got the second largest lithium royalty portfolio assembled. So I think we're pretty well diversified, including some of those key metals. But yeah, the funny thing is, first of all, from a supply-demand perspective, the reason why I think there's a difference in the gold space, there's gold everywhere. It's really about the fundamental of economics and, is it worth getting out of the ground? Whereas, all of these different metals, which are essential for all different types of technology that are essential for, modern life in the 21st century, they were already facing and looking at, supply-demand imbalances coming forward. the clean energy transition, it's just really thrown that into overdrive. And so we've already been mining, for a lot of these metals, especially copper, the best deposits on the planet already for, 50 plus years. And so I think the supply demand imbalance for all these different metals, which we really need, are really the fundamental driver over the long term. And so why we feel really great about our thesis. I definitely think there is a lack of capital to this space, for all the big money and the $1 trillion of, infrastructure spending and all that. Very, very, very little of it is actually going to explorers, developers, groups that are looking to bring in new production. So it's there's definitely a lack of capital out there to the space. I wouldn't want to be a developer and operator right now, because they have to raise equity and keep moving stuff forward. And it's a very dilutive and capital intensive process. Whereas, you mentioned we've had, about $500 million going into our portfolio. That's really no cost to us. So our portfolio keeps developing and it doesn't cost us anything. We don't have to go out to market and really dilute ourselves in a big way to see meaningful growth. And so I think we're kind of lucky in that regard, but definitely still lots of opportunities out there. If we had better access to capital as well, we'd be doing a lot more deals.
Interestingly, it's almost the lack of capital for the explorers, the lack of the punitive dilution that the explorer developer, the people who are not raising kind of build construction finance, but actually looking to raise money for more drilling, for resource definition, for the de-risking episodes of PEAs, pre-feasibility studies. That capital is so expensive at the moment. And in a way, that's actually giving you the opportunity to sign up these new royalties, which is what you've been able to do in the great bear market of the last 2.5 years. But you wouldn't want that to continue for too long.
Yeah, well, it's kind of funny. Well, I look at our, let's just take our producing royalties. Our actual cash cost acquisition on those, funnily enough, is only about $1.75 million. Our Authier Lithium royalty, we acquired that a number of years ago as our going public transaction. Our cash cost on that was only about $500,000. But back then Sayona was a $5-6 million company. $500,000, not that we actually gave them, that was an existing royalty, but $500,000 to them would have been 10% dilution. And you look at where they're at today as a $2 billion company. So it makes a big difference when it's early on like that. But our royalties, those 3 producing royalties, our zinc royalty, it's on vertically integrated, the only primary zinc producer in the US, right? That's kind of crazy. Our lithium royalty is going to be on really the only and largest lithium mining operation in Canada. And our tin royalty that we just closed on, that's the largest and only producing tin mine in all of Europe. And so I think it's pretty, after, so really, those are the most advanced and the onlys. After that, you have to get into development exploration, right? And so capital has to go there to really support demand or sort of supply coming down the road. And it's not. And so that really is just going to mean, I think, higher metal prices, for those metals, because that development pipeline of projects really isn't being supported. But, it provides an incredible opportunity for us. We don't have any competition really on non-dilutive funding for, developers and, explorers for these metals.
But you wouldn't want it to last for too long. Because you want you want to have a window where there's start for capital, where you can go in and you can sign the royalties, but you don't want it to last too long because you actually want other people to be putting money in to advance. Once you've got your royalty base in there, you want other people's money to be coming in and driving the sector, no?
Yes, I think the nice thing is about being diversified with 9 clean energy metals is that some of those metals are going to be able to attract capital like the lithium space has. But we're expecting to be cash flow positive at the end of this year, and if we do absolutely nothing, we see your portfolio growing significantly in cash flow over the next kind of 5-6 years to a much better place. So theoretically, we don't really have to do anything. It's just we can be opportunistic. I think there is a tremendous opportunity if you look at our, acquisition costs, the deals that we've done, what we're paying on stuff for us to be able to keep growing and keep adding deals like that. I think it's very, very hard to lose. And I think when you look at the macro, long-term picture, the portfolio is going to look, very, very smart, down the road. But at the same time, we don't have to, so we're not in any position where we're desperate or need to do something in a bad market or a downtime. We can just be opportunistic, keep picking away at good opportunities and kind of go from there.
you mentioned earlier the kind of the cost of capital, kind of the punitive cost of capital for equity juniors. Can we just talk about your cost of capital and the in mid-January you took out a credit facility with one of your larger shareholders for $5 million. The interest rate on that is 15%. Is that what you see as kind of being a fair cost of capital for the company? I mean, let's talk a bit more about that.
Yeah. Well, okay. So let's be reflecting. So right now, I believe we've only done up to $2 million. Was that facility with our largest shareholder? He is our largest shareholder. Owns close to 20% of the company. 15% interest rates, the headline number. That's what always attracts people's attention. I think if you actually look at what the other groups that lend to the junior mining space are actually getting, I mean, their all-in cost is closer to 20%, anyways. Regardless of if their headline interest rate is 10 or 12.5 or what. Generally those groups are lending at about a 20%. Now, when I say all in, there's stuff that goes into, what your actually cost of capital would be, especially on a facility like that. And so, we have none of those on top, right? There's no structuring fee. Typically groups will require you to pay about 2% of whatever they're giving you just right up front. That just goes back in their pocket. That's just the cost of, you have the capital there. Typically, you're paying interest on the amount that's undrawn. So if they're putting a, say, $5 million facility together, you're paying interest on that $5 million. We're only paying basically on what we've drawn down. So right now, we've only drawn down $1 million. We have another deal which we've just announced that's going to cost us $500,000. We're planning to use the facility to close on that, and we might increase the facility, nominal amount as well. I know our largest shareholder, Stefan, he's very supportive. He'd do a much higher number if we wanted. But there's a lot of good things about this facility. It's convertible at 50 cents a share. There's no interest payments over the life of the loan, so it's all capitalized and due at the end of term, which is 3 years. I think over a 3-year period, we're not really worried, at all about where our portfolio kind of gets to. And there's no early repayment fee. So, really this is a facility that lets us just kind of keep doing deals, not missing deals. But if we were to say, be valued at a place where we could raise equity tomorrow and we wanted to repay this, I mean, there would be no early repayment cost of any kind. And so there's a lot of different benefits to this, I think, that you'd never see, quite frankly, from any other lender out there. And it's, partially because they're our largest shareholder. And so they're very supportive. So that 15% number, I don't think that's crazy. Generally, I think it actually probably compares, pretty well. But when you look at the extra, add-ons and items that, people might not necessarily see in the headline, but definitely exist, in the space. I think this is a really just kind of good facility to let us keep growing right now, without doing anything to really hurt the shareholders of the company.
And you have an internal discussion. You obviously have that discussion to say that this is a less dilutive approach than raising capital at the book value that when you need money to transact on the royalties that you wanted to on which you wanted to transact.
Yeah, it's very flexible, and so it just kind of gives us flexibility right now to keep, doing deals that we don't want to miss out on, like our Panuta acquisition that we closed on earlier this year. So it's about flexibility. I think the funny thing is, if you ever announce to the market you need to do financing, they're to come crush you. And so, I basically said we will never do an equity financing, not until it's at a fair valuation. And so this really just lets us, make sure that we can just keep growing and don't have to, pull the trigger on anything unless it suits us.
Well, let's pick up on those words, fair valuation, that you've just used. What do you, your market caps, where are we? $35 million. Your share price is 37 cents. What's
yeah, grossly undervalued would be, I think if you look at some that we now have, a few better comps out there. I think Lithium Royalty Corp just went public recently, did a raise. I think their market cap's around 800 million. We have more royalties than they do now. I think we're definitely much better diversified. They're 100% lithium, whereas we're diversified across 9 clean energy metals. They've got a couple royalties that are in the construction phase that are big royalties for them. So, there may be a couple years ahead of where our portfolio is and some of our bigger development stage royalties. But would I say that they're worth 20 or 30x their valuation? I mean, definitely not. I think there's definitely a multiple of wiggle room in there. And so I'm hopeful that you look at some of those valuations, people will start to understand the value in our company. But it's still painful. It's been painful, to be where we're at. I think makes it more difficult to do deals. But I think we're still finding very cheap opportunities to be creative. Despite that.
I looked up a presentation of one of your peers, who's also a couple of years ahead of you, and they're trading at around $200 million market capitalization, and by their revenue estimates, they're trading on around 10 times cash flow, and the peer group that includes them is trading on somewhere between 20 and 25, if you want to include the outliers or not. Does that surprise you? Is that what you look at?
That doesn't surprise me. And I think if you look at the bigger groups like Franco-Nevada and the much more diversified groups, you'll see even higher earnings multiple. It could be, I think, as high as 40. And you see it on the NAV valuations as well. Typically the junior royalty companies, I wish we were getting that, but it would trade about 1 times NAV. And as you get bigger, more diversified, the big guys trade up to kind of 2.5, even higher sometimes. So I think a lot of that just comes as you're, keep growing, you get a little bit more diversified. Nice thing is I think our portfolio, we are very diversified. No one asset right now, makes or breaks us. They're all, fairly equally invested. And we're across 9 different metals. So I think we're a little bit more diversified than you see at some typically, smaller junior royalty companies. But over time, that should definitely be a re-rating that we would hope to capture. But let's start getting, that fair valuation at a junior royalty company level, before we.
Well, I recall from the last time we spoke, you felt that you were under, I can't remember whether you said under 0.2 or 0.3 NAV, but it was a kind of, it certainly wasn't, there was plenty of room to get to 0.5 NAV, let's put it that way. In your estimation. Now, what are the triggers for that? How's the market going to, what are the catalysts going to be that are the unlocking of gradual value for you to close that discount to NAV?
It's a good question. Something definitely that I've been, pondering. And I think, to be honest with you, I don't know if it'll happen ahead of the private equity guys doing something because, there's a lot of private equity groups, some very big pools of money out there. And to do due diligence on a portfolio of 22 assets like us, it's harder for retail investors to do. And so, I think ultimately those guys have a bit of an edge, quite frankly, because they have teams of people, and a lot of those groups really love the royalty space to understand royalties from different sectors. And so, that's one option. One potential route is that, unfortunately, retail investors never wake up to it in time, and private equity comes in and they make them a lot of money, versus investors. But I think I'm hoping that, as we get cash flow positive this year, some of our other royalties are advancing close to production. We add a couple more producing royalties. I think that'll be a big catalyst, cash flow positive, where it means you don't have to dilute anymore. We can actually fund deals out of cash flow. And so I'm hoping that'll be the catalyst that gets, retail investors there. But it'll be a race against the private equity groups, who definitely,
So, as in the private equity groups could be a kind of a group that kind of a predator, kind of a bigger fish that might want to come and swallow you guys up.
Yeah, well, I think you see in all those groups now would get invited to things like a Lithium Royalty Corp IPO, and so they're definitely getting aware of opportunities and valuations in this space. I think for us, a lot of those groups typically wouldn't look at us because we're still too small, right? They want to write $100 million checks and such. But if you were to do say due diligence on a Lithium Royalty Corp IPO, they've got the biggest lithium royalty portfolio. We've got the second biggest, and there's really nobody else besides us. So I think you see a lot of those groups looking at now getting invited to the space and kind of checking around. So I think it'll be interesting. And like I said, I mean, those groups have, they got teams of people, to go through and really do deep dives. So I think the space is just heating up. It's going to be exciting, definitely, as we move forward.
Interesting. I know that private companies like to do kind of placements along the way. They like to kind of get in new investors just once in a while, just to show the kind of the growth and value of the company. The equity market is a kind of a slightly strange beast like that because it's so emotive and it's so volatile that
it's definitely not efficient, I can tell you that. And it's, it's funny. I mean, somebody just sells shares on the wrong day on a Friday, your stock goes down 5%, and now then you're building a trend into the next week and all the, the day traders start hitting you too. It's funny. Yeah, it's not efficient. I don't think necessarily us being public right now, is the best, most efficient way out. If we were still private, definitely would be raising money at a better valuation, like all the private equity groups have been. And we'd be monetizing it. It'd be much easier to monetize and say, hey, our valuation is X, like all the private groups have been. I think it was helpful for us while we were growing. It was really the only option. We went public just as COVID was happening, and we have used our share capital to get a lot of deals done that we couldn't have otherwise. But I think if you look at the private side of things and what groups are doing, the valuations are off the scale, relative to what you're seeing in some of the public markets.
Funnily enough, that was when I first saw the private equity groups playing in the public markets. In the last cycle, it was in 2013, 14, 15, because the private equity groups realized that they had much better value entry into projects through the equity markets than they did through the private side, because the private companies were able to hold their value, whereas the equity is being crushed by the guy selling small amounts of volume on the Friday afternoon, for example. Talking about, you've mentioned the private equity guys who've got the teams and the ability to run the slide rule over the entire portfolio. And you've spoken about the difficulty of retail investors to kind of understand the detail of the entire portfolio. What about the institutions? What are the conversations that you're having with institutions? Because they like a value discount.
Yeah, I think, even still, there's just such a lack of expertise, even among the institutional groups, about how to assess clean energy metals projects, whether it's lithium or tin or, even nickel. I think there's just such a lack of, people that really know what they're doing and where to put money. So I think we've had a funny amount of groups talking to us, just trying to figure out, where are opportunities in the space and where could they deploy capital. So I think that's kind of funny because there is a lot of money right now that's sitting on the sidelines that has just been sitting there for, 12 months or more, hasn't invested in stuff. And that's partially because they don't really know this space. And it's a brand new space. The clean energy metal space barely existed, 5 years ago. It's definitely going to have to grow. It's the human resource side of it because, the size potential and where we're going. But I think there's a lack of, qualified people on the investment side. I think for us too, it's just kind of a function, unfortunately, of size. And so it's a real chicken and egg problem. You don't get analyst coverage from a major bank until I think the smallest groups they cover about 100 million, valuation. Typically want to be about $50 million in size. So an institutional group can come in, write a $5 million check. They don't go over that, 10% ownership threshold. So those are kind of two benchmark, I guess, from a institutional group perspective. But
a couple of comments on that. One is that the brokers won't want to cover you if you're not issuing equity. You won't get a buy recommendation unless you're writing checks to them. The other is the way to get your...
We'd have to work out a deal at some point when it made sense. There would be an equity raise at some point down the road, only in exchange for analyst coverage, and I'll hold that hostage and threaten to get till it happens. So, but yes, you're right. I mean, there'll definitely be a price to pay at some point.
And then on the market capitalization side, you're halfway there really, which is a great start. And the conversation to have that is just buy $5 million of stock in the open market, and you'll get the liquidity, and the market capitalization will soon be $50 million. I mean, it'll a higher price. You've just got to persuade someone to get in there and get buying on the open market.
Yeah, and I think we've cleaned up a lot of our kind of free stock that's been out there. I mean, if you look at Stephen Gleason, his ownership's up to close to 20%. Myself and my family, combined are about 14%. Then we have Globex, that gets us to just between those three groups, close to 50% of our shareholding. So, I think we're getting fairly tight. Yeah, those groups it's funny, a lot of especially the institutions. They all want a deal. They all want to, you know, look smarter than the next guy. And so a lot of those groups are always trying to get stuff at a discount, you know. Same as you get a lot of retail investors that they're excited about the story and they're, I'll wait and see what price I can buy in. And so, yeah, finding those buyers to come in and really see that, you know, you could buy this thing up quite a bit and still you'd be doing very well. Yeah, it's a funny thing, but there's very few groups out there, you know, like that. But I think we're working on it.
Did you say Globex as in Jack Stock?
Yes. Yeah, we did our first, we've done 2 deals with them. And that's how they acquired their ownership. I think they've sold maybe 1% of the shares that they were given, but they've been long-term shareholders since the beginning, and great partners. So yeah.
And do they build their position by you doing issuing royalties on their properties, and that's how you give them cash and equity? Is that how they build up their equity position?
So we actually acquired some royalties from them, and so we acquired our first package of royalties from them as part of our RTO, and then we also acquired the Middle Tennessee Zinc producing royalty off of them in partnership with Sprott, who came in alongside of us for $13.5 million. And so yeah, we did those 2 deals, but through those they basically got shares ownership in Electric Royalties.
Good. Well, I've really enjoyed this conversation. It's been very different to the previous ones, which was kind of more on an asset basis, and this is much more macro. Just on the, if I'm going to be kind of a stock watcher for the rest of the year, what can I look at on a kind of a proactive basis rather than just kind of observing on a reactive basis? You know, what have you got? What's brewing? What's cooking?
Yeah, well, I mean, there's lots of stuff that are coming on a reactive basis. You know, if you look at our asset update, we just had an asset update on 7 royalties. Our last asset update was like a month and a half ago. You know, so essentially that was about 7 updates on our portfolio over the course of a month. I think you'll definitely continue to expect to see that. You know, we should get our first check from our Panuta acquisition, which closed in January. Very shortly, we should get our first check from Authier, our lithium royalty, later this year. And so I think those are all things that are just coming that we should look forward to. Beyond that, definitely we're going to go get a couple more producing royalties would be my target. You know, we've already got now zinc cash flow, tin cash flow. We're going to have lithium cash flow. I'd like to get some copper cash flow, you know, in the near term. And so I'm hoping that we'll be able to go pick up another producing royalty or 2. And then we've got some kind of interesting deals in the works as well. I think if you look at us, we've been very creative how we built this portfolio. And I would expect that we're going to be, you know, especially creative this year, you know, on the deal front, trying to put some deals together. So, you know, lots of good stuff coming, you know, just from the portfolio built, but definitely don't sleep on us because we're going to be active and definitely putting a couple more deals together.
Great. Thank you very much for the update. Good talking to you, Brendan.
You as well, Merlin. Thanks for having me on. Always a pleasure.